Today I want to talk about whether APE will be delisted, or if the squeeze will happen first, or if there's a secret alternative that Adam Aron could implement to prevent APE from being delisted, forcing the squeeze. So stay tuned and let's make some money. And now I'm going to dive straight in with the key information. So Tony Diary tweeted saying he's had lots of questions about the APE delisting notice and a reverse split. He said on the New York Stock Exchange the price has to be under $1 for 30 consecutive trading days before a compliance notice is sent out. He said that would make the timing mid-January, and you'd also need to assume there's no price bump in the APE stock from the Avatar release starting mid-December. Basically saying that if APE bounces back above $1, even for only one singular trading day, it resets that 30 consecutive trading day period. Now we know these shorts are trying all they possibly can to ensure that APE is delisted. They're trying to push the stock down and manipulate it every single day to ensure that APE falls below $1 for those 30 consecutive days. But what exactly are the rules around delisting? Will APE be delisted, and can Adam Aron do anything about it? Do we just wait those 30 days and APE magically disappears, or is there a longer process involved with more stringent compliance requirements? Well, I want to talk about exactly how these shorts have been manipulating the APE price and how it's becoming more and more obvious on a daily basis. I want to talk about how they've exposed themselves to this synthetic shorting and how they have no other choice. They're not shorting APE because they want to, they're shorting APE because they have to. But let's start by talking about these delisting requirements and what exactly the rules are. Well, Investopedia says the listing requirements vary from one exchange to the next. For example, on the New York Stock Exchange, if a security's price closed below $1 for 30 consecutive trading days, that exchange would initiate the delisting process. Now, the New York Stock Exchange would start this delisting process by issuing an initial notice of non-compliance, or a non-compliance notice. Upon receipt of that compliance notice, a New York Stock Exchange listed company has 6 months to bring its share price and average closing price back above $1. It says a company can regain compliance at any time during the 6-month cure period if on the last trading day of any calendar month during the cure period, the company has both a closing price of at least $1 and an average closing share price of at least $1 over the 30 trading day period. Now that sounds a little bit confusing, but it's basically saying that in any 1 month period, it has to have an average closing price of at least $1, and on the very last day of that period, close above $1 as well. Therefore, let's say in January or February for the first 2 weeks, APE closes around 90 cents every single day. But then for the second 2 weeks, APE closes around $1.10 or $1.11. The average closing price is $1 or $1.01, give or take. Now, if that happens, the delisting process stops and APE isn't at risk of being delisted, unless again it falls below $1 for 30 consecutive trading days, and then a new delisting process is initiated with a new 6-month time period. Now, I managed to find a real practical recent example of this happening. On November 14th, 2022, Starry Group Holdings received a deficiency letter from the New York Stock Exchange notifying the company that it's not in compliance with the applicable price criteria. It said as of November 7th, the average closing price of the stock was less than $1 per share over a consecutive 30 trading day period. And therefore, Starry has a 6-month period following receipt of the deficiency letter to bring its share price and average share price back above $1. Now you may say, Tom, if these shorts push APE below $1, which they already have, and hold it there for 30 consecutive trading days, and then hold it there for another 6 months with constant manipulation, does that mean APE gets delisted? Technically, the answer to that question is yes, APE would be delisted if the shorts can hold the price of APE below $1 for 6 consecutive months. However, I do think the squeeze will happen first, and I do also think that Adam Aron has a secret tactic to avoid that delisting. Now, Investopedia also says to avoid being delisted, some companies will undergo a reverse split of their stock shares. This has the effect of combining several shares into one and multiplying the share price. For example, if a company executes a 1-for-10 reverse split, it could raise their share price from 50 cents per share to $5. Moomoo is currently doing their biggest ever giveaway for the Christmas period. They're currently holding a $60,000 sweepstake giveaway, and you also get 20 free shares worth up to $2,000 each when you sign up to Moomoo right now using the link in the description below. Now, I think a reverse split is an excellent idea for the APE stock, and it also means that Adam Aron can still issue a large amount of APE shares and pay down the AMC debt. Now remember that AMC and Adam Aron are pre-authorized to issue up to 4.5 billion additional preferred shares of APE to raise cash. Now if there's a 1-for-10 reverse split, Adam Aron can't issue 4.5 billion APE shares, but he could still issue 450 million APE shares. And obviously if he performs this reverse split, the stock would increase from 90 cents per share up to $9 per share. If he then sold 450 million APE shares at $9 per share, that's around $4 billion of cash. Now obviously that $4 billion of cash would pay down the AMC debt, and Adam Aron would only have to sell off 450 million shares, or even less. On top of that, I also believe the APE stock and AMC will squeeze before this 6-month time period actually elapses. Don't forget, right now we are already in the midst of the market crash, and many believe the recession is already here. Obviously, the US government hasn't yet admitted to a recession, but the stock market is crashing, and over the next 6 months, I expect it to crash significantly more. And obviously, as I've said, when the market does have that final Hail Mary crash, it will cause the liquidation of many hedge funds, causing the squeeze. I personally think this market crash and liquidation wave is likely to happen within the next 6 months and not in 12 or 18 months, for example. Obviously, if Adam Aron issued the APE stock back in 2021, that would have been too soon before the market crashed. Whereas he's issued it right now, it's the perfect timing as the market is already crashing. Therefore, right now, I don't really think that APE is at risk of being delisted because Adam Aron has so many options. Adam Aron can see how the next 6 months play out and see whether the market crashes first, causing these hedge funds to be liquidated, forcing the squeeze. And if the market doesn't crash over these next 6 months, Adam Aron can still perform this reverse split of the APE stock, reverse splitting at say a 10-to-1 ratio. He can then continue to sell off 450 million APE shares, raising nearly $4 billion of cash to pay down the AMC debt. Not only would this ensure that APE isn't delisted, as it pushes the share price well above $1 to say $9 or $10 per share, but it also assures AMC's financial stability, raising $4 billion of cash and paying down all of the AMC debt. This then puts the shorts in a very sticky situation, especially when you consider the Springboard Theory from earlier this year. We know the spring for both AMC and for APE has been pulled back so far and it's ready to snap. These shorts have been continually suppressing the APE and AMC springs, tighter and tighter and tighter and tighter. As they continue to manipulate both the APE and AMC stock, it compresses these springs even more. But obviously when you suppress these springs, there comes a point when there's a catalyst that causes these springs to rebound, firing these shorts upwards, firing the price upwards, and liquidating those shorts. As these shorts continue to suppress and manipulate the APE price, it suppresses this spring further and further. And obviously if APE does not end up being delisted due to a reverse split, it effectively causes a springboard. And to see how close we are to that springboard, or to see how close we are to that market crash, Black Swan Event tweeted saying Lehman Brothers collapsed 5 days after reaching 610 basis points on their credit default swap pricing. Right now, the Credit Suisse 5-year CDS is around 400 basis points and continually increasing day by day. This article from September of 2008 suggests the 5-year credit default swaps on Lehman Brothers rose 135 basis points to a record high of 610. And if we look at these 5-year credit default swaps on Credit Suisse right now in October and November and December of 2022, we can see the 5-year line in blue is already over 400 basis points. That means that right now Credit Suisse is approaching that Lehman Brothers moment of having a 600 basis point CDS where it will eventually go bankrupt. And obviously if Credit Suisse hits the dust and ends up going bankrupt, it will liquidate their entire portfolio, liquidating many other hedge funds along the way, crashing the market. And we can now see the shorts exposing themselves to exactly how they're manipulating the APE price by forcing more and more shares and more trades through these dark pools. There was a time when we were surprised seeing 60 or 70% of AMC trading off exchange, but now we're seeing 90% of APE trading off exchange on a daily basis. Yesterday we saw 80% of all volume going directly off exchange, with 4.57 and 3.2% going to the CBOE and New York Stock Exchange dark pools. Only around 6.5% of trades went directly through the Nasdaq, directly through the New York Stock Exchange, or through the IEX exchange as well. So on a daily basis, we're now seeing 90% of all trades going directly off exchange. But are those trades made up entirely of professional hedge fund trades or majority made up of retail investor trades? Well, Market Charmeleon is showing the majority of trades are going through these dark pools and not going through these lit exchanges, as can be seen from this chart here. But we can also see that actually very few of these trades are institutional trades or professional trades or even small trades. The majority of these trades come directly from retail investors, here in red. Even though these dark pools were designed for these large institutional big block hedge fund trades, they're actually not being used for that. They're being used for what they were not designed for, which is passing through retail investor volume. These dark pools were designed specifically for these hedge funds and for nobody else. They were for these hedge funds to make trades that would not significantly impact the market, not to feed through the retail investor volume, crushing and hiding their volume. We can now see these shorts are getting desperate, increasing their daily dark pool usage from 60 or 70% up to 90% on a daily basis. This goes to show how much these shorts are panicking, how much they're on their last leg, and it goes to show they're not shorting APE because they want to, they're shorting APE because they have to. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.